All right, so we're going to start from chapter number 14 today. So that will be our short-term decision making. And the next chapter will be long-term decision making. So both chapter will be from the decision making purpose. Now, when we said like decision making, what exactly that mean? That means the company have some policy, the company have some procedure before they can introduce any product in the market, before they planning to invest in any area. For example, let's say if the company to decided to manufacture or decided to make a pen. Now, before they decided to sell this pen in the market, they have to determine the cost, they have to determine the selling price, and they have to know what is the market demand. So they have the enough resources or they have the enough capacity to produce all of this, and how profitable it will be if they start selling this on the market. So there is a lot of consideration that business do before they actually sell the product in the market. On the other hand, sometimes the company think like they have some investment and they're planning to invest in different area. For example, they say, let's say they have a 10,000 pound and they're planning to invest in project A, B, and C. So which project will give them more profit? Which project will give them more return? Which project will bring the investment quicker? So all of this consideration the organization made by using these techniques. So today we're going to see all of these techniques. The first one we're going to see from chapter number 14, that will be for short-term decision making. So all the technique we'll see from this chapter, that will be for the short-term decision making purpose. And the next chapter, chapter number 15, that will be for the long-term decision making purpose. So let's have a look what we have in this chapter. So we move to chapter overview. And in this chapter, we can see there is a lot of formulas we have. It's the better if you have a pen and paper, you can make a note of that. It's very, very important to memorize these formulas because in the exam, you will not have this formula. So you have to remember, you have to memorize all of this formula. This analysis is called CVP analysis. Now, the meaning of the CVP is cost, volume, profit. So we'll analyze the cost, we will analyze the volume and the profit. There are few formulas. I'm going to write it down for you, and you have to remember those formulas in order to calculate this CVP analysis. So let's write it down. The first thing I'm going to discuss about BEP. BEP. That is break-even point. Break-even point. Now, the break-even point is the point where the company make no profit, no loss. So if someone tell you, like if you ask your friend, for example, you have a friend and he is doing business, and if you ask him, how's your business going? And if he reply to you, I'm in the break-even, that means he's not making any profit or he's not making any loss. So he is on the middle. He is in the zero situation where there is no profit and no loss. So break even means break even break even means no profit and no loss. So break even means no profit, no loss. Now, when we calculate the break even, we have to know what is the formula to calculate this break even and why we have to calculate the break even. For example, let's say we are decided to sell this pen in the market. So we want to know how many unit of this pen I have to sell in the market to keep myself in the break even. So for example, if I can sell 1000 pen, and if my break even is 1000 pen, for example, that means if I can sell up to 1000, I will cover my cost. I will cover my fixed cost. So if I can sell up to this amount, up to the break-even amount, so my fixed cost will be covered, and I will be in a situation where I will make no profit and no loss. So break-even means no profit, no loss. Now in break-even, we have two situation. The first one is the unit, and the next one is the value. So unit means is a quantity. So let's talk about the first one. Break even, in the bracket I'm writing q. Q means quantity. So break even quantity, the formula here is fixed cost. FC means fixed cost over contribution per unit. So on the bottom it will be contribution, CONT, contribution per unit, fixed cost. So on the bottom it will be contribution per unit. So fixed cost over contribution per unit is the break-even quantity. The next one we're going to learn, number 2, also BEP, break-even point, but this time it is a value. So I'm making a dollar sign so we understand it is a value. The formula here will be fixed cost. On the top it is same, but on the bottom this time it will be CS ratio. CS ratio. Now what is CS ratio? So let's talk about the CS ratio. CS ratio. CS ratio means contribution to sales ratio. CS ratio means contribution to sales ratio. There is a very easy way to remember the CS ratio. So the C will go to the top. So C means contribution. Contribution. And S will come to the bottom, and S is the sales. So CS ratio means contribution to sales ratio. Contribution will be in the top, sales will be on the bottom. I'm sure all of us will know what is contribution. Contribution means selling price minus variable cost. If someone asks you to calculate the contribution, you know how to calculate it. Selling price minus variable cost equal contribution. The next one I'm going to write the formula that will be targeted profit. So I said TP. TP means targeted profit. Now the formula will be for the targeted profit, that will be in the top. We're going to write fixed costs. On the top, we're going to write fixed costs plus targeted profit. So on the top, we're going to write fixed cost plus targeted profit. On the bottom, we're going to write contribution per unit. So contribution per unit. So on the top, it will be fixed cost plus the target profit. And on the bottom, it will be contribution per unit. The next formula I'm going to write, that will be margin of safety. Margin of safety, or we can say MOS. Margin of safety. Margin of safety basically is your safety zone. For example, let's say if you, when you drive a car, we have some reserve on the car. So even the oil is finished, if the petrol is finished, if we are running out of the petrol, but still we have some reserve that we can use it. So margin of safety means like we have a safety level. So for example, if our plan, we're going to sell 10,000 unit of this pen, and if our break even is 8,000, so the difference between the forecast and the break even is called margin of safety. So the margin of safety will be budgeted sale minus break even, BEP. So margin of safety will be budgeted sales minus break even. So we'll do some practice, we'll understand more. And of course, like we're going to use all of this formula in the question. Now, another thing we're going to learn from this chapter, that will be called limiting factor. So a limiting factor will not be tested widely in this chapter, but little bit we need to know for that. So let's have a look. What is the limiting factor? So in the corner, we can see a little bit. They said the limiting factor, limitation. Now let me say about the limiting factor. What is the limiting factor? Limiting factor is basically when we have a limited amount of resources. Now, when I say resources, what I mean either the labor hour, either the machine hour, or the materials. So something we have shortage, something we don't have enough. For example, let's say we want to make two products, X and Y, and we have a demand in the market. So let's say in the demand for X we have 1000 unit, for Y we have 1000 unit. Both product have a demand in the market 1000 and 1000. And let's say X take 2 hours and Y takes 2 hours. To make 1 unit of X, we need 2 hours of labor. To make 1 unit of Y, we need 2 hours of labor. So for the X, we need 4000 and 2000, isn't it? So 2000. For the Y, we need 2000. So total, we need 4000 labor hour. 4000 labor hour we need if we like to fulfill the demand. So if we want to fulfill the demand, that is 1000 and 1000 for both product, we need to have 4000 hour available. Now the question is, what if we don't have 4000 hour available? For example, we have only 3000 labor hours. For example, we have only 3000 labor hour available. So which product I'm going to make, which product I'm not going to make? This is the question. So if I have only 3000 hour, should I make X? Should I make Y? So how am I going to decide? So the first thing is like come to our head, we will make the product that gives us more profit, isn't it? So we're going to make the product that will give us more profit. Now, in this limiting factor, remember that we are not looking for the profit, we are looking for the contribution per limiting factor. So we're going to check which one give us more contribution per labor hour. So we're going to check contribution per limiting factor. And after that, we'll decide which one give us more contribution. Is it X or is it Y? For example, X give me contribution per hour 5 and Y give me contribution per hour 6. So I will make all the Y first 1000 unit, and any hours remaining I'm going to make X. So I will use all the hours for Y, and any hours left then I'm going to use it for make X. So that's how we decide when we do the limiting factor question. So we'll see some question and hopefully we'll understand from there. So let's move on inside of the chapters and we'll see how many questions and what type of questions we have from this chapter, and we'll try to solve together, and hopefully after that it will start making more sense. All right, so let's move to the first question. The activity 1. The first activity we have that is called break-even units. So let's try that one, break-even units. So in this question, we can see the question is telling us a business has a single product that it sells for 28. So the selling price is 28 pound. The variable cost of the production is 19. So variable cost is 19, selling price is 28. And the fixed cost of the business, that is 360,000. And they're asking what is the break-even point of unit. They're asking for the unit. That means the formula number 1, The formula number 1 we have discussed here. This is the one we're going to use. So for this formula, we need the fixed cost. So on the top, we're going to write the fixed cost, that is 360,000. And on the bottom, we need the contribution. Now, for the contribution per unit, we have to find it. How we find the contribution? We said sales minus variable cost. So sales is 28. So 28 is the sales and 19 is the variable cost. So 19 is the variable cost. If we make the difference, so that will be our contribution per unit. So 28 minus 19, and that gives me 9, isn't it? So variable cost per unit is 9. Contribution per unit is 9. So we said 9. And if we divide that, that will give us how much? 4,000. Very well done. So 4,000 unit, this is our break-even point. And this time we're doing the units. So this is the way we can calculate the break-even unit. And you see, if you remember the formula, the question will be really easy for you. So obviously, all you need to do, you need to use the formula. So if you use the formula, that will be really good. Is it 40,000? Okay, so I'll add one more zero. Thank you, Michelle. So if I add, of course, like one more zero, that will be like 40,000. So if you know the formula, that will be really easy for all of us to calculate it. All right, let's move to the next one then, activity 2. This time we are doing break-even revenue. So we have to multiply with the selling price. We need to know how much is the value. So let's have a look. The question is telling us a company has a different output levels. A company has a different output levels and incur different total production costs and each level. So as follows. So we have a total output 6 and 8, and the total cost we have 44 and 57. The requirement here is a break-even point unit and the revenue both. Now we can see we don't have any variable cost, isn't it? And we don't have any fixed cost. We have only the selling price. We have only the selling price, but we don't have any fixed cost or not the variable cost. So what we think, how we can identify that? Which method we're going to use to identify the fixed and the variable cost? Can anyone tell me which method we're going to use to identify the fixed and variable cost from here? Yes, Nadia, we're going to use the high-low method. Very well done. So we're going to use the high-low method. So I hope all of you remember it's still your high-low method. So take the higher unit and the higher cost. So we said 8,000 unit and the cost is 57,700. Then we have 6,000 and we have 44,700. So the difference is 2,000. And we'll find the difference 57,700 minus 44,700. That will give me the difference. That will be 13,000. And after that, we'll take this one to find the variable cost per unit. So we'll divide 13,000 divide 2,000. And that will give me variable cost per unit, that is £6.50. So now I have the variable cost per unit. So I can identify now fixed cost. So let's pick anyone. You can pick 6 or you can pick 8, anyone. Let's say I pick 8,000. So for the 8,000 unit, the total cost is 57,700. And if I take out the variable cost from the total cost, whatever will be the remaining, the leftover will be the fixed cost. So I said 8,000 times 6.5, the variable cost per unit, 6.5. That will give me the total of my variable cost, that is 52,000. Thank you, Nazia. 52,000. And if I minus it from the total cost, the remaining will be my fixed cost. That will be 5,700. Very well done. So now I have the information that I need. So I have a fixed cost, I have a variable cost, and I have a selling price. So now I can do all of this. So I said, okay, let's do the BEP unit first. So fixed cost and contribution per unit. So I said the fixed cost is 5,700 and the contribution per unit. So 8 is the selling price. 8 minus 6.5 is the variable cost per unit. And that will give me the contribution. So obviously, if I divide that, that will give me the break-even unit. So how much it is? So we have 5,700 divide is 1.5. So that is 3,800 unit. 3,800 units. So that's my BEP. So I'm going to write 3,800 units. And asking for the revenue, that's quite simple because I have the selling price. I don't have to use the CS ratio, so I just multiply with that. So 3,800 times 8, and that will give me the total sales volume. So can we have the figure for that? 3,800 times 8, that will give us 30,400. That's the value. That's it. So this is the break-even revenue. If anyone have any question, please feel free to ask because we can explain more if you still don't understand. But in the exam, if you see the question, there is no variable cost. If there is no fixed cost, there is nothing to worry. Maybe you have to use the high-low method to find your variable cost and the fixed cost. And we know how to do it. All right, then. So let's move on to our next question. So let's move on to the next question. Just let me clear all of this. Okay, the next question we have, that is contribution to sales ratio, that is CS ratio. So let's try to do that. It says following, using the detail from the break-even revenue activity 2, the last activity we have done, find the CS ratio and the break-even revenue. So CS ratio, if you remember the CS ratio from here, that is contribution in the top and the sales in the bottom. So CS ratio. So I said contribution. Do you remember how much was the contribution for that? So our contribution was 1.5 and the sale was 8. So contribution was 1.5 and the sales per unit was 8. So what will be the CS ratio? Remember, the CS ratio always we express as a percentage. So we have to multiply by the 100 to make it percent. So we said 1.5 over 8 times 100. So that will give you the percentage for the CS ratio. The question shows the percentage. That's why we have to multiply by 100. So we said 18.75. Very well done, Jeno. Very well done, Azia. The next one we have break-even revenue. The one we done before. Now we want to do it with the same thing, but by using the CS ratio. So we said fixed cost in the top. So we said fixed cost, that is 5,700 that we have calculated. And on the bottom, the CS ratio, that is 18.75. So if we want to write it down without the percentage, 18.75, how much it will be? So 18.75 divide 100, that will give you without percentage. So it will be 0.1875, isn't it? So that will give us the break-even revenue, and it will give us the same answer, 30,400. This is just a other way to calculate the break-even revenue. So the question can ask you anything, but if you know all of this, that will not be difficult for you. All right. So let's move on to our next question. So the next question we have for the margin of safety. And the margin of safety is basically the difference between the budgeted sale and the break-even sale. And if the question asks you for the percentage, you have to divide with the budgeted sale. So budgeted sale minus the break-even sale. So that will give you the percentage if you multiply by 100. If the question only asks you for the margin of safety amount, then you just do this thing. So you just do this thing. All you need to do, you need to say budgeted sale minus break even sale. So budgeted sale minus the break even sale, it will give you the margin of safety unit. But if the question asks you a little bit more, if the question asks you for the percentage, then you have to divide with the budgeted sale times by 100 to get the percentage. All right, let's try this question, everyone. So activity 4, we have the requirement using detail as per the break-even revenue example above, and with budgeted sale being 5,000 units. So budgeted sale is 5,000 units. The question tells us calculate the margin of safety. So if the budgeted sales is 5,000, do you remember how much was the break-even unit? It's 3,800, isn't it? 3,800 was the break-even for the last question. So the difference will be our margin of safety, and that will be 1,200 unit margin of safety. So 1,200 unit. And if we like to show it as a percentage, what we do? On the bottom, we write again the budgeted sale, and that will give us the percentage. So 5,000 and times by 100. That will show us the percentage. Is it 24%? Thank you, Nazia. So it's 24% margin of safety. If you have any question, please let me know so we can discuss more, or we can move to the next question. If you can remember these formulas, this question will be really easy for all of you. But my advice will be, please read the chapter, because in the chapter there is a lot of explanation that might give you more knowledge. The last one, Michelle. So we can say the last one. Let me see if we can see it. So the percentage, isn't it? All right, so this is the last one, Michelle. So we have 5,000 is the budgeted sale, and 3,800 is the BEP. That's from the last question, because they said the previous example. So example above. And they said how much is the margin of safety. So budgeted sale minus break even is the margin of safety. So budgeted sale minus break even. So 1,200 is the margin of safety. This is the 1,200 here. And they said what is the percentage. If you like to get the percentage, you have to use this formula. So 1,200 is the margin of safety, divide the budgeted sale, that is 5,000 unit, times per 100, that will give you 24%. That's it. I hope you get it, Michelle. So let's move on then. In real life, it's depend on sim, like how you want to use it. So this is basically, for example, you are in a business and you want to know like how many unit you really need to sell to stay in a break even. so that you can set your target. For example, if you just keep selling your product and you don't know, like, are you in a profit or are you in a loss? Or for example, you don't know like how many you need to sell more to make a profit. So if you know your break even point 100 pen, for example, so you said, okay, up to 100 pen I will cover my break even, but if I can sell 101 pen, so one pen will bring me the profit. So you know your target, so you can push your employee, you can push your marketing staff, you can set up a new strategy, so make it more sell. If you know your target, you can work on it. But if you don't know your target at all, so you don't know you are making a profit or loss, so you're just working. All right, so you're welcome. So let's move on to the next question that we have: targeted profit. Now if you remember the formula for the targeted profit, number 3, the targeted profit, the formula is fixed costs plus targeted profit divide contribution per unit. So they said, using the data from the break-even revenue example above, if we need to make a profit 10,000, calculate the required sales volume. So how much we need to make a sale if we want to make a profit of 10,000 pound. So this will help you to understand. So if you decided I want 5,000 pound profit, so how many unit I should sell? So this formula will tell you how many unit you should sell if you like to make a profit 10,000. So we said fixed cost, the formula here. So how much was the fixed cost? 5,700 plus the target profit. I like 10,000 pound profit, 10,000 pound profit, and the contribution per unit. If you remember the contribution per unit, that was 1.5, and that will give us how many unit I have to sell in order to make 10,000 pound profit. So 5,000 plus 10,000, that is 15,700, divide 1.5, and that will give you the unit, and it is 10,467 unit. Thank you, Nazia. So this is the unit we have to make sell in order to get profit 10,000 pound. All right, so let's move on to our next question. Let's have a look what we have. There is so many things here to read. You can read yourself. That will be helpful for you. Now we move to one of the question that for the limiting factor. So we discussed very little about the limiting factor, and there will be not many question in the exam for the limited factor, but if there is, so that you can answer it, so we need to make sure you understand the limiting factor. So limiting factor is the limiting factor is the question where some of the resources will be very limited, so we'll not have enough resources. It could be the labor hour, it could be the machine hour, it could be the materials, raw materials, it could be anything that is not enough to fulfill the demand. So if this is the situation raised, then you have to understand this is the limiting factor. All right, so activity 6, scattering. Let's read this question. Said scattering fixed cost for the year have been split. So for the standard meal, 32,500, and for the vegetarian meal, 179,500. The total cost, fixed cost, is 212. The latest sale forecast. Let's just sell forecast means the plan for the sale for the next time. Forecast means it's not done yet. It's not actual. Forecast means it's going to happen. Forecast means is a plan. Forecast means the budget. Sales forecast for 100,000 standard meal and 200,000 for vegetarian. So we make a plan, we made a budget for the next period. We're going to make a sale for the standard meal 100,000 unit, and we're going to sell 200,000 vegetarian meal. It takes 0.025 hours to make a standard meal. To make one standard meal, we spend 0.025 hours and 0.03 hours to cook a vegetarian meal. So this is the hours we need. So 0.03 and 0.025. Calculation have shown meal type contribution to be as follows. So contribution So if I sell one standard meal, my contribution is 40 pence. If I can sell one vegetarian meal, my contribution is £1. This is the trick. This is the trick. Remember, in the exam, they will show you standard meal give you less contribution and the vegetarian give you more contribution. It looks like that. But you don't take this until you check yourself, because we are not looking for the contribution per unit, we are looking for the contribution per limiting factor. So we are looking for the contribution per limiting factor. All right, so let's move on, have a look what else we have for this question. So we have a requirement. In the requirement we can see they're asking to complete the table below to calculate the break-even sale in meal for standard and vegetarian, the margin of safety for each of these two type of meal, the margin of safety as a percentage. Okay. And the next one they're asking, as a result of staff shortage plan for the year, the number of labor hour available has been reduced to 8,000 for the year. This is the situation. So you can see we have only 8,000 hour available. So it doesn't matter, we have a demand for 1 million unit in the market, but we don't have enough people to carry on the work. We don't have enough labor hours. So what happened? I can only produce up to 8,000 labor hours. We need to see by using this 8,000 labor hours, how many unit we can make. All right, so we'll see that. So let's have a look. Is there anything else we have? No, that's it. So let's write it down the question in the corner so that we can see the question when we actually do the question. So it's a standard meal, the fixed cost. So we have a standard meal, vegetarian meal, and the total. So 32,500. Then we have 179,500. And the total is 212,000. And we have the demand in the market. For the standard meal we have 100,000. For the vegetarian we have 200,000. And the hours, labor hours, for the standard we need 0.025 hours, and for the vegetarian we need 0.03 hours. Contribution is standard meal we have 40 pence and £1 for the vegetarian. All right, so now we can move on actually the question and try to solve it here. So the fixed cost, the question already gave us the fixed cost, so we don't have to worry about that. So the fixed cost for the standard, that is 32,500. For the vegetarian we have 179,500. Then meal contribution, so 40 pence we have for standard, and we have £1 for vegetarian. Now the break-even meal. So break-even meal, how much will be the break-even meals? So fixed cost over contribution. So if I divide that, that will give me the break-even, isn't it? So we have for the standard, we have 81 to 50, 81 to 50. And for the vegetarian, we have 179 is same 500. Very well done, Nazia. Then forecast sale. The question said the plan is 100,000 and 200,000. So it said the forecast sale 100,000, 200,000. Margin of safety. This is the difference between the forecast sale and the break even. So that will give us the difference. So 100,000 minus 81 to 50. The difference is called margin of safety. So it is 18,000 750 for the standard, and for the next one 20,500. And finally the margin of safety percentage. So obviously that is, you already know, margin of safety, divide the budgeted cell. So that will give you, so if you divide with that, that will give you the percentage. So 18.75% for the standard, and for the vegetarian 10.25. All right, so this is the way we can do our question. Is very simple. You see, you just copy the information. It's not much thing here to understand. All right, so let's move on to our next one. So let's have a look. What is the next one we have? The next one we have, complete the table. Let's read a little bit information in the top. It said, as a result of a staff shortage, planned for the year, the number of labor available has been reduced to 8,000. So basically they said the labor hour is reduced to 8,000. So that means we have only 8,000 labor hour available. We don't have much. So obviously, even though we have a lot of demand on the market, but we cannot fulfill the demand. The reason is we don't have enough people to carry on the work. So let's read the requirement. The requirement here is complete the table below to recommended how many standard and vegetarian meals should now be served in order to maximize the profit of S catering for the year. So they're asking, as you have a limited number of hours, so what will be the best way? What will be the best solution to make the meals by using the 8,000 hours? So I said, okay, I need to see some calculation. First, I need to see which one give me the more contribution. So I need to see which one give me more contribution per labor hour. So if I see the standard gave me more contribution per labor hour, I will make the standard. If the vegetarian give me more contribution, I will make vegetarian first. So I'll look for which one give me more contribution, and I will make a rank. So I'll say rank 1, rank 2. That means I'm going to make you first, then the next. So let's have a look. This one. The first thing we're going to write contribution per meal. So for the standard, we have 40 pence per meal. And for the vegetarian, we have £1. Then total labor hour per meal. So if you remember, we have a 0.025. So 0.025 hours. That's for standard. And for the vegetarian is 0.03 hours. So contribution per labor hour. So you see, it's not even hour, it's the very point, like 0.025, maybe like few minutes. So if I need this amount of hours to make one standard meal, how much will be the contribution per hour? So per meal, the contribution 40 pence. And in 1 hour, how many meals we can make and how much will be the contribution? So how we calculate that? So if we have 0.40, can anyone tell me how much will be the contribution per hour? Want to see? You can do it. 16 for this standard. Yes, that's correct. But how you do that? All you need to do, you need to divide, isn't it? So contribution divided by labor hour. So if you divide that, 0.40 divide 0.025, that will give you 16. That means in 1 hour, the contribution is 16. So for this amount of time, the contribution 40 pence. Based on that, in 1 hour, in 60 minutes, the contribution will be £16. Same we do for the vegetarian. 1 divided by 0.03, and that will give us the contribution 33 0.33. That's it. So this is our contribution for standard and vegetarian. Now all of you need to tell me which one we're going to make first, vegetarian or standard. So shall we fulfill the demand for vegetarian first or the standard? So we can see the vegetarian, it gives me the contribution 33 per hour. So that means I will make all the vegetarian first, and if I have any hour left, then I will use for the standard. So I said that's my ranking. Ranking number 1, vegetarian. Ranking number 2, that will be standard. Then I said, okay, the next one, labor hour allocated to type of meal. So we will use all the demand for the vegetarian. So now how many demand we have for the 200,000 for vegetarian? So for 200,000 times, we need 0.03 per meal. So how many hours we need here for the vegetarian? So 0.03 times 200,000, it gives us 6,000 hours. 6,000 hours. So we need 6,000 hours for the vegetarian. So we said we need 6,000 hours here. And how many hours we have total? 8,000, isn't it? So if I already use 6,000 from the 8,000, how many hours we have left? 2,000. So from 8,000, if I already use 6,000 for the vegetarian, so 2,000 is left for standard. Now, can anyone tell me, by using the 2,000 hours, how many meal we can make? How many standard meal we can make? So every meal takes 0.025 hours, isn't it? So 2,000 divide 0.025, and that will tell me how many meals we can make. So that will be our 80,000 meal, because one meal take 0.025. So 2,000 hour, I can make 80,000 meal. Very well done, Luis. So we can use here, with the 2,000 is here. I'm going to use 2,000. All right, so 2,000 is here. Now, total contribution earned. Total contribution earned. Now here I'm making basically for the standard, I'm making how many meal? 80,000 meal. And here I'm making 200,000. So you can go with the hours. So if you go with the hours, you can multiply with that. If you go with the meal, you can multiply with that. It will give you the same result. So we can say 8,000 meal times 40 pence. That will give me 32,000, 80,000. Yeah, 80,000 times 0.40. So 32,000 is the contribution for the standard. And we can say 200,000 times 1. That will give us 200,000 anyway. So this is the contribution. And if I make a total 32 plus 200,000, that will give me the total contribution, and that will be 232,000. 232,000. And if I minus the fixed cost, if you remember the fixed cost here, 212. So 212 is the fixed cost. If I minus it from the contribution, the leftover will be the profit, and the profit will be 20,000. All right, so any question from here? If you have any question, please let me know. Otherwise, we can move to the next question. All right, very good. Let's move on to the next question then. The next question we have the limiting factor. We'll do the same thing, the thing we done before. So let's have a look. So activity 7, limiting factor decision. SA Co sell two product T and J for which the following details are available: direct labor, direct material, variable overhead, fixed cost. The selling price, maximum demand 10,800, requirement if only 40,000 labor hours are available per month. So if there are only 40,000 labor hours are available per month, what is the best use of labor to generate the maximum possible contribution? So what is the best way to get the maximum profit for the company? So see that the first thing we'll do contribution per unit T and J. Can we find the contribution for T and J? So we have a selling price T and J. The selling price for the T is 25, for the J is 22. From here we minus all the variable cost. So less variable cost. So we have few variable costs. We have a direct labor, we have a direct material, and we have a variable overhead. 3, isn't it? So we have 15, then we have 10 here, then 2, then 5, then 2, and 2. So that will give me the contribution for T and J. So how much is the contribution we have for T? So for T we have a contribution 6, and for the J, how much is the contribution we have for the J? So we have 22 minus 13. So we have so 7, 17. So we have 10. This is 2, isn't it? So 2 and 3. So we have 5. That's 5. So it's 17. Sorry, it's not 3. My 5 look like 3. So basically is 10 plus 5 plus 2, 17. So 17 minus 2, 22, it will be 5. Sometimes writing on the board is not very clear. So obviously we need to always double check so that we have the right figure. Now we can see the contribution we have per unit, that is 6 for the T and 5 for the J. Now it's look like we should do T first and after that J, because T have a more contribution. But please remember, we are not looking for the normal contribution. We are looking for the contribution per limiting factor. We are looking for the contribution per limiting factor. Now we have to find the contribution per limiting factor. So let's have a look. What is the contribution per limiting factor? First, write the contribution here. So we have a 6 and we have a 5. After that, hours taken. Can anyone tell me how many hours T take? So he said 5 per hour and 15 is the total. So how many hours? 3 hours taken by T, and the J said 5 per hour and 10. So that means 2 hours. So 2 hours, because if we divide 15 divided 5 is 3 hours, 10 divided 5 is 2 hours. Now we need to identify contribution per labor hour. So can we get how much is the contribution per labor hour? So 6 is for total for 3 hours. So how much is the contribution in 1 hour? So in 3 hours, if the contribution is 6, so 1 hour will be 2. 6 divided 3, it will be 2. And this one will be 5 divide 2, that will give you 2.5. Now you see the situation will be changed. Before that, we have seen the contribution for the T was more than J. But now we can see it is changed. Now J gave us more contribution than T. So my ranking will be changed now. So which one I should make first, then which one the next? So am I going to make J first or T? So I'm going to make first all the J, isn't it? Because J giving me the more contribution. So I want all of you to understand this. This is ranking number 1, that's ranking number 2. Do not look at the first contribution that we got here. Always look at the contribution per labor hour, because labor hour is the limiting factor. So now we know we will make J first, and after that we'll make T. So let's have a look how much J we're going to make and how much T. So you can see we have a demand 8,000 unit for J. So I said J is 8,000 unit, and every unit need 2 hours. So 16,000 hours I'm going to use for J. And how much will be the contribution total? Each hour will give me contribution 2.5, isn't it? So 16,000 times 2.5, that will give me how much? 40,000. That is my contribution from J. So how many hours we have left? So from 40,000 hour, we have used 16 for the J. So we have 24,000 hour left. Can anyone tell me how many unit of T we can make by using the 24,000 hour? So T we can make, so 24,000 hours we have, divide by 3. So that will tell me we can make we can make 8,000 unit. 24,000 hours we have, and every unit take 3 hours. So we can make 8,000 unit, and each unit, so each hour the contribution is how much? 24,000 times 2. Per hour we have a contribution 2, not the per unit. Remember that, not per unit. We have the contribution per labor hour. Remember that. So contribution per labor hour. So 24,000 hour times 2, that gives me 48,000 contribution. So total contribution, how much it will be? 40,000 from J and 48,000 from T, and that will gives me the total contribution 88,000. So that's how we can do that. Of course, we can discuss again, Joseph. So 24,000. So let's talk about that. 24,000. So we have total 40,000 hours, and we need to use all of this to make J and T. Now for the J, we going to fulfill all the demand for 8,000 unit, because J give us the more contribution. So for 8,000 unit, and the per unit we need 2 hours. So we need 16,000 hours. Remember, not the unit, 16,000 hours. 16,000 hours we need to fulfill the demand 8,000 unit for J. And every hours we have a contribution for the J 2.5. So multiply by 2.5, and that gives me the total contribution 40,000. So we multiply with the hour 16. So the next question is how many hours we have left. So from 40,000, if we use already 16, so we have a left 24,000 hours. So 24,000 hours, how many unit we can make? So every unit of T, we need 3 hours. So if we divide by 3, so we can make 8,000 unit. Now the contribution per hour, not the unit, remember that. So this 24,000 hour will give me the contribution not the unit. Remember that. So because the last one we have also multiply with the hour, not the unit. So 24 times 2, that will give you 48,000 total. So 48 plus 40, that will give you 88,000 total contribution, because the contribution is calculated on the hours. Got it, Joseph? So let's move on to this one. Here we just need to fill all of this. So we can see they're asking the optimization plan. So we need to say 8,000 unit, and the hours is 16,000, and the total contribution 40,000, then 8,000, then we have 24,000 hour, and the contribution 48,000, and this is total 88,000. That's it. If we know the workings, obviously like that will be very easy to just fill in the box. So the main thing is the workings. All right, so anyone have any question from here before we move to the next topic? No, very good. So let's move on to our next topic. I think this is the end of the chapter. So let's move to the next chapter and we'll see what we have on the next chapter. The next chapter we have, this chapter is called long-term decision making. So this time we are not talking about short term. This time we're talking about the long term. Now, long-term decision making, what is it? What does that mean? It means when the company decided to make investment. Sometimes you see uh, so many big companies, they make investment in different countries. For example, if you see in London, the London Excel, that was invested by the Abu Dhabi company from Qatar. So there is a lot of investment in London that is make from a different country, and the London make a different investment in different countries. So this type of investment, before they make the investment, they check the visibility. So they check the feasibility of the investment. So there are few things they consider before they make the investment in one business or one project. So they try to see a few things. The first thing they check that is like how quickly the money will be returned. So for example, if I invest 1 million today, how quickly I will get it back from this project. So this is number one consideration. And in the accounting term, we called it payback period. So let's go to the chapter overview, have a look. The first one we have, that is called a payback period. The payback period is all about how quickly we will get a return of our investment. So say how long it take to get the money back. So return period. Return period. Now in the payback period, every company have a policy. For example, let's say you have a business and you have a policy. Uh, if 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 the investment takes more than 5 years, you're not going to accept the proposal. So if any investment take more than 5 years to get the return back, you will reject that investment. So this is the policy. So when you calculate the payback, if you see if it is less than 5 years, you said accept the project. If you see you will get the return after 5 years, maybe 10 years, then you said reject the project, because the company have their own policy 5 years. If we don't get the return within 5 years, we reject the proposal. So basically, this is uh, this is the uh, this is the benchmark set by the company, and in the exam they will give it to you. What is the company policy? The question will tell you if the payback period is more than 5 years, reject the proposal, reject the investment. If the payback period is less than 5 years, then accept the proposal. So question will tell you. So payback period only consider how quickly you will get your money back. Now remember, payback period. If the question said like, what is the advantage and disadvantage of payback? So you need to tell payback is very easy to calculate and it show us how quickly we can get our money back. But on the other hand, what is the biggest disadvantage? What is the biggest disadvantage of the payback period? The biggest disadvantage of the payback period is it never consider the time value of money. It never consider the time value of money. What is time value of money? The time value of money is the value the value of the money is never same. So the value of the money is never same. For example, if the £1 value is today £1, but after 10 years, the value of the £1 will not remain £1. For example, if you check like 50 years back, maybe the one house price was 200,000. Now after 50 years, the same house price is 100,000, is become double. So that means the time value of money is not always same. The value of the money always reduce, is going down. So if you look at like maybe 30 years back, maybe the potato was 50 pence kilo, now it is £2 kilo. So value of the money always reduce, remember that. So when you make the investment, you have to consider that, because the time value of money will be reduced over the time. So let's say if someone said, give me £10,000 now today, £10,000 today, give me £10,000 today, and I'll give you after 10 years, I'll give you 10,500. So if you give me 10,000 today, after 10 years, I'll give you 10,500. Now it's look like you're getting 500 extra. So look like you're getting 500 extra, but actually it is not. In 10 years time, the value of the 10,000 will go down. So maybe today, whatever you can buy by spending £10,000, and after 10 years, you have to spend 12,000 to buy the same thing, because the value of the money will be reduced. So when you consider that, this is called time value of money. Time value of money. And the way we calculate that, this is called NPV, net present value. Net present value. By using the NPV formula, we bring back the future value into this value. So for example, if someone said, I'll give you 10,500 in 10 years time, I said, okay, wait, let me see how much is the value of the 10,500 today. So whatever you're giving after 10 years, if I convert the value to this value, how much it will be? And if I see it is less than 10,000, for example, it says 9,000, I said, sorry, I'm not going to give the 10,000, because I'm giving you 10,000, but you're giving me actually 9,000 back, not 10,500, because the value of the money will be reduced over the time of the 10 years. So when you consider the time value of money, we called it NPV. So net present value is the way we calculate the time value of money. Uh, why do bank gives personal loan then? So when you take a loan from the bank, could be personal loan, could be business loan, or could be overdraft, the bank will charge you interest, and this is their income. So the interest rate will be always above the time value of money. So let's say if the inflation rate is 5%, if the inflation rate is 5%, they will charge you 15%. So they will still have a profit from your loan 10%. They will still have a profit from your loan 10%. So they will charge you the interest that will be more than the interest rate. So if you, for example, you see now because of the pandemic, the government tried to give so many advantages to the people, giving some furlough scheme. They extended till September. They're giving a lot of grant to the business. Now you might think, why the government not printing a lot of money and give it to the people? Because the government have a machine. Why the government don't print a lot of money? The reason is, if you keep printing the money, the value of the money will go down. if you keep printing the money, the value of the money will be reduced. For example, if you read the history, uh, after the Second World War, the value of the money in Germany, it was too low, very low. So that was kind of an example. Let's say you keep all the money, a lot of money in a box. So someone came to your home to steal something. So what they did, they take all the money and keep on the floor, and after that they take the box. So the box was full of money, so they keep all the money on the floor and they take the box. So the box was more valuable than all the money. So the value of the money was that down. So there was carrying a big kind of scooter type thing to carry the money because the value of the money was that down. So obviously, when the inflation rate is really, really high, the value of the money will start going down. So that's why the government cannot print or cannot do whatever they like, because this is the currency has to be set up with different country currency as well. All right, so this is our NPV. So this is the difference between the payback and the net present value. The payback doesn't consider the time value of money, but on the other hand, the NPV, net present value, always consider the time value of money. The next point we have that is called IRR, internal rate of return. Internal rate of return. So internal rate of return, this is another topic we have to understand. Even though there is a very rare chances the question will come from IRR, but it still is better to know. So every money have a cost. We called it cost of capital. Cost of capital. Cost of capital. And obviously, when we invest the money to any project, we have to assume this money have a cost. This money have a cost. Now let's say if the cost of capital is 10%, if the cost of capital, so this is the cost of the money. If the cost of capital is 10%, so my return need to be more than 10%. Because if my cost is £10 and if I sell it for £10, I'm not making any profit. If I buy something, this one like £5, if I sell it for £5, there is no profit for me. So my cost of capital, if it is 10%, the return has to be more than 10%. This is the IRR, internal rate of return. The IRR has to be more than cost of capital. So if it is more than the cost of capital, we said accept the project. If it is less than the cost of capital, we said reject the project. That's it. All right, so let's move on and do some questions. We'll see how the question will be in the exam, and hopefully you'll understand more from there. Make sure you read the whole book. Is very important because in the exam they will give you so many additional information, and the only way you can write if you read the whole book. So not just doing the practice, but there is a lot of information in the book. This is also very important for your understanding. All right, so let's move on to the first one, activity 1. In this activity 1, we have a payback period. Payback period. Cvp PLC. So Cvp PLC is considering a 5 years project that requires an initial cash outlay of 550,000. So initial cash outlay means this is the investment. So at the initial investment that you have to spend. Now, if I invest 550 today, that will give me some return. So that's my investment. On equipment, if I buy some asset, at the end of the project, the equipment is expected to have a scrap value 25,000. So that means when the useful life of the asset will be finished, I can sell it for 5,000. So let's say if I buy asset, I have used it for a few years. After that, I will be able to sell it for 25,000. The equipment will produce annual cash operating revenue 150 for 5 years. So the next 5 years, I'm going to receive cash flow 150,000. So what we understand from here, we invest today 550,000, and the next 5 years we're going to receive 150 every year, and at the end of the 5 years also will receive 25 extra as a scrap value. Kirby has a required payback period 5 years. So company have a policy, we have to get the return within 5 years. If we don't get the return within 5 years, we will not accept the project. What is the requirement? The requirement here is calculate the payback period of the project and state whether Kirby PLC should accept or reject the project on the basis of payback period. All right, so let's do that. On year 0, we have investment. On year 0, we just invest the money. So this is the outflow for us. So he said on year 0, I'm going to invest 550,000. And this one I'm going to show in a bracket because money is going from the business. Money is going out from me. So I'm going to show it as a minus figure. So I'll say cumulative cash flow, the same figure, 550. Cumulative means the total so far. That's minus. In year 1, I'll receive 150. Actually, every year I'm going to receive 150. 150. 150. 150 for the 5 years. Every year so I'm going to receive 150. But we have to remember at the year of 5, we're going to receive 25 extra from the scrap. So 150 plus 25, so 175 at the last year. Now we'll see when actually the money will be returned, my investment. My investment was 550,000. So after the first year, my investment will be still left with the company 400,000. It's still minus. So from 550,000, I received 150 after 1 year, and still I have minus 400,000. Year 2, I receive another 150, so still I have 250 minus from the company. Year 3, I have received another 150, so still I have 100,000 minus. And 150 I receive 4 years, but we can see I need only 100,000. So we have 100,000 still on the investment that I need to get back all my investment, but I have received here 150, isn't it? So actually I don't need 150 to cover the year number 4. So if the question is, so we can see here I'm becoming plus here. So here I'm not minus anymore, I'm plus. And again here I receive 175. So 175 plus 50, that's give me 225. Now can anyone tell me how long actually it took to get my investment back 550,000? So how many years it took to get my investment back from this project? So I can say I need for year 1, I need full year 2, I need full year 3, isn't it? So I need the 3-year full. But year number 4, I don't need the whole year because in year number 4, I have received 150,000, but I actually need 100,000. So I said I need 3 years plus I need 100,000 over 150. I need only 100, but I receive 150. And I'll multiply by 12 to get the month. 12 is the month. For the whole year, we have 12 months. So if I do that, that will give me the month. So if I do that, how many months? 8 months. Okay. So I said the return will take 3 years, 8 months. 3 years, 8 months. Now the company policy is if I get the return within 5 years, then I'll accept the project. If I get the return after 5 years, then I'll reject the project. So we are getting the return within 5 years, isn't it? So should I say accept or reject? What are we going to say? Should I accept the project or should we reject the project? We should accept the project because the payback period is lower than the company policy. So we said accept it. So this is the way we can calculate the payback period and we can take the decision. So now you know how we calculate that. You have any question from here? Anyone have any question from the payback period? All right. So if you have no question, then we can move to the next one, but maybe you can take a break because this is the last chapter we're doing. So let's take a break and we'll come back 8 o'clock and we'll do the rest of the chapter. So in activity 2, NPV, net present value, Cvp PLC. Let's read the question. It said Cvp PLC is considering a 5 years project that requires an initial cash outlay of 550,000 on equipment. At the end of the project, the equipment is expected to have a scrap value 25,000. The equipment will produce annual cash operating revenue 150,000 for the 5 years. Cvp has a cost of capital 10%. So that's fine. So cost of capital is 10%. Now, this type of question, this DF or discount factor will be given in the exam. So when they ask you to calculate the NPV or the net present value, they'll give you the discount factor. Because in AAT level, they will not ask you to calculate the discount factor. But in future, if you do your charter accounting course, and that case, you have to know how to calculate the discount factor. So for example, if I like to calculate the present value, so for example, the formula for the present value is future value divide 1 plus r to the power n. But you really don't have to remember this type of formula. On your AAT, they will never ask you to calculate the discount factor. This discount factor always will be given in the exam, so you don't have to worry about it. So let's start this question. The first one is year 0. And year 0, we already know our cash outflow, that is 550,000. I wrote the bracket so that I understand it's a minus figure. That's my investment. Now this is the today's value. It's a 0 period. Year 0 means it's today. So if I invest today 550,000, how much will be the value is that for today? So this is the present value. Present value means today's value. So if I said I have 500 pounds today in my hand, and how much is the values today? So you will tell me 500. So when I'm in 0 year, so I have to multiply by 1 because the value of any money today should be the same value. So I said the value is same. So I'll multiply by 1 and that will give me the value 550,000. Still on the minus. And then year 1, we have 150,000. Year 2, 150,000. Year 3, 150,000. Year 4, 150,000. And year 5, 175,000 because 25,000 will come from the scrap. All I have to do, I have to multiply with the discount factor. You can see the first discount factor for year 1, that is 0.909, the next one 0.826, then 751, 683, and after that 6209. So basically all this discount factor is going down. You can see 98766. So more is the year. You can see year is going down. At the same time, discount factor is going down. So that means if I multiply with that, that will give me less present value. We are calculating the present value. So we will get less present value. So for example, if I have £1 today, and if I get it after 5 years, so I'll say 1 times this one, 0.62.09. So let's say if someone gave me £1 after 5 years, the today's value will be 62 pence, like that. So we are finding the present value from the future value. So this is all the future value, 150, 150, 175, because this one I'm going to get in future. If I try to convert this value into today's value, that will give me the present value. So let's do that. 150,000 times 0.9091. So that will give us 136,365. Then we have the next one, 150,000 times 0.8264. That will give me 123,960. Then we have the next one, 150,000 times 0.7513, and that will give us 112,695. Then we have 150,000 times 0.6830, and that will give me 102,450. And finally, we'll do 175,000 times 0.6209, and that will give me 108,657.50. That's it. Now the question we have, how to calculate the NPV. So NPV, the way we calculate NPV, this is all the plus figure. This is plus, this is plus, that's a positive, all this plus figure. So you added all of this and minus it from the investment. So if the return is more than the investment, that is 550, that will give us positive NPV. If the return is less, then that will give me negative NPV. So if I added all of this, all the return, and if it is more than the investment, that is 550,000, so that will give us the positive NPV. If the NPV is positive, remember that if the NPV is positive, we will accept the project. If the NPV is positive, we will accept the project. If the NPV is a negative, that means if the NPV come in minus, we have to reject the project. So if the NPV is positive, then we have to accept the project. If the NPV is negative, we have to reject the project. Now, for example, even if your NPV is 0, is not positive or is not negative, still you need to accept the project. So it will never happen in the exam. But if it is ever happen, like you see the NPV is 0, it's not positive, or it is not negative, you will still accept the project because that will still cover your cost of capital. So the NPV here is how much? 34,127.50. That's it. Any question from here? If you have any question, ask me now. Otherwise, we move to the next question. All right, so let's move on to the next question. The next question we have here again, that is for NPV and the PP. PP means the payback period. So we have a two question here. One is for the NPV and one is for the PP, that is payback period. So this time it's not a cash inflow, but it is a savings. So the following are the relevant cash flow of a project. We have a capital expense, so that means that's my investment. capital expense means is your investment, so that will be the minus. After that, we have a indirect labor cost savings. This is your inflow. Operating cost saving, this is your inflow. So these two are inflow. So let's do that. So first we do the capital expense, that is 720. We're going to write here 720, and we keep on a bracket because it's the investment, the money will go out, is the outflow of the cash. Then we have indirect labor cost savings, 340, 348, and 448. So we write 340, we have 348, and 448. Then we have operating cost saving. On the operating cost savings, we have 264, 272, and 270. So we said 264, 272, and 270. So this is my total saving. If I added this to net cash flow, so 340 plus 264, that will give me 604. This is the outflow we have, 720, so minus. So that is 604. And then we have 348 plus 272, that gives me 620. And we have 448 plus 270, that gives me 718. So this is all the information we need, we already have now. Now look after the present value factor, that is 14%. So the first one is 1. Year 0 will be always 1. Remember that. Year 0 will be always 1 because the value of the £1 today is £1. So if I multiply with the 1, that will give me 720 anyway. 720 is a minus. Now we do the discount factor. So 604 times 0.8772. So if you multiply that, that will give you 530. Then we have 620 times 0.7695. That will give you 477. And 718 times 0.6750. That will give you 485. That's it. All the information we need, we already have. Now, I'll give you 2 minutes to tell me what is the payback period here and how much is the NPV. So everyone try, I'll give you 2 minutes. So we'll see how many of us can calculate that. Well, the main point I want all of you to focus here, the reason I give you a few minutes to check yourself. When you do the payback, remember, we do not consider the discount factor. We do not consider the DCF. So we do not consider the discount cash flow factor. So we only consider the net cash flow. So when you do the payback period, we do not consider this amount. We consider the top amount. Because the payback period do not consider the time value of money. Very, very careful. Payback period do not consider the time value of money, but on the other hand, the NPV always consider the time value of money. So let's sort it out, the NPV first. So we have 530 plus 447 plus 485. And if you minus it from the 720, that give us how much? 772. This is my NPV. So 772, that's my NPV. The next one I'll do the payback period. So the payback period, I can see my investment is 720. And on the first year, I have received how much? 604. So from 720, I already received 604 on year 1. So I need year 1. So still I have some investment. That is how much? 720 minus 604. That gives me 116. So this is my investment is still left. So year 1 I need full. Year 2 I receive 620. I don't need the full year 2, isn't it? I need just little bit, 116 from 620. So I said I need only 116 from 620. So if we do that, 116 divide 620, and that gives me 0.187. So if I add with the year number 1, so that will give me 1.187. So we can say 1.19 years. If the question doesn't ask you for the month, you don't have to multiply by 12. Only you do multiply with 12 if the question asks you for the month. So we said 1.19 because we are taking the 2 decimal, and after the 8 we have a 7, so we make it 9. So that's how we can do our NPV and the payback period. Any question from here? Payback. So you can see the first year, the total investment is 720 OSIM. And at the first year, we have received 604. So at the first year, we have received 604. So out of 720, you already received 604. So only 6116 is still remaining as investment. And on the next year, we receive 620. So we don't need 620. We need only 116. So 116 divided 620, that gives me 0.187 years. So I need the full year, year number 1. I don't need the full year 2. I just need little bit from year 2, that is 116 over 620. And that gives me total 1.19 years. So 1 plus 0.8187 or 1.19. Got it, Asim and Luis? Very well done. So let's move on to the next question. The next question we have IRR, internal rate of return. As I said, there's a lot of information in the books. Please read this because in the exam, you're not going to see the same question. The question will be different. So you have to have knowledge inside so that you can do whatever is the requirement. So let's do IRR. Before we do the IRR, let's write it down, the formula for the IRR. If you have pen and paper, write it down because this formula not in the book. So IRR equal, I would say NPV lower percentage plus NPV lower NPV lower minus NPV higher times higher minus lower percentage. It's very easy. So basically the first one is NPV L, L for lower. It's a percentage, so definitely we will show the percentage. NPV lower, but this time it is the amount. This is all the amount, is the value. So NPV lower, but this time it is not percentage, it is amount. Then on the bottom, we have NPV lower, this is the value, minus NPV higher, it is the value, times NPV higher minus lower, that will be the percentage. So the first one and the last one is the percentage, but on the middle, this is the amount, the value. So let's do this question. It says the NPV of a project is 1679 when the cost of capital is 10% and 49 when the cost of capital is 20%. So what do you understand from here? So NPV lower percentage, so lower percentage is 10% and the higher percentage is 20%. That is Tidora. The formula is NPV-L, that is NPV lower percentage, plus NPV lower L on the top, on the bottom NPV lower minus NPV higher times higher minus lower. Only the first side and the last one, that's the percentage. On the middle it will be values, the amount. So let's try to understand again. So we have the percentage 10% and 20%. So 10 is the lower and 20 is the higher, isn't it? So 10 is the lower, so I'm writing L, lower percentage, and this is the higher, 20 is higher. We understand 20 and 10, so 10 is the lower, 20 is the higher. So this is the percentage. Then this one, NPV higher value, so this is the higher value, and this is the minus, that's the lower value. So that's it, that's all information we need. So let's do that. The first one, NPV lower percentage, so lower percentage is 10%. We said 10% plus NPV lower amount. Lower amount is, for the 10%, the amount is 1679. So we write 1679. And then we have on the bottom NPV lower again. So 1679 again. On the formula, I take the minus. Very careful here. On the formula, we have a minus. But here you can see before 49, we have a minus. So minus minus actually it will be plus. Minus and minus actually it will be plus. So we have a formula minus and we have a minus here. So minus minus will be plus 49 times higher minus lower. So higher is 20%. So I'm writing 20% minus lower is 10%. So 10%. That's it. So that's how we need to present the formula. So we have lower percentage plus lower value and lower value plus higher value times higher minus lower. If you do once time in the paper, it will be clear for you. It's not difficult thing. So how much it is here? So what is the result we have here? So we'll do the way we do. First we added this two. First we add this two. That is 1679 plus 49. Then 1679 will divide with the result. After that, we multiply with the 10. So 20 minus 10, that will be 10. We multiply with the 10. And after that, we plus the 10%. So this is the way you have to do. Remember that. So if you do everything at the beginning on the calculator, it will not give you the right answer. So first you calculate the middle part. Then you multiply with the 10%, the difference. And after that, you add a 10%. This is the last one you do. And that one will give you 19.72. Yeah, so 19.72%. Very well done. So that will give you 19.72%. Even though this question will be hardly tested in the exam, but still you need to know, because there might be a question from the IRR, but it is not a big area for you. It's just a little understanding they give it to you for the IRR, but it will not come you as a huge question. But it's better to remember the formula if the question come in the exam. Otherwise, you will not be able to answer that. So make sure you remember all the formulas, especially for the CVP, that is for the short-term decision making. For example, break-even, target profit, margin of safety, CS ratio. All of this formula has to be on your head. On the other hand, this IRR formula, NPV, payback has to be on your head as well. Because from this chapter, you expect at least 10 to 15 marks in the exam. So this chapter number 14 and 15 will give you at least 10 to 15 marks in the exam. All right, so let's move on. Which one, Michelle? So we have for that, you mean this 19.72%, you didn't get this? So as I said, you have to do that. So 1679. In the bottom, you do 1679 and you plus with 49. So first you do this bit. After that, you times by the 10, that is the 10%. So you multiply by 10. And after that, you add 10 plus 10. So that will give you 19.72%. If you spend a bit time on the calculator, you will get it. It's not a big calculation. So the next point, we have advantage and disadvantage for the IRR. Every single question we are doing from here, NPV, payback period, or IRR, every single have some advantages and disadvantages. So make sure you read this chapter. I'm saying so many times, make sure you revise the every single page you have on the book. Do not skip it, because in the exam it's not going to be same question. If you do not read the book, you will be in trouble in the exam. So make sure you read every single page you have in the book. All right, so this is the end of the chapter. You can see we don't have much thing for uh, the last chapter. So this is the end of the chapter 15.